Ladies and gentlemen, welcome back to our latest edition of our Basel IV channel. You might have asked yourself why it took them so long to post a new video on the Basel IV channel. The reason is definitely not because we were too lazy to make new videos and post them on YouTube. The reason is simply because Basel IV is such an important topic, therefore we were extremely busy with performing impact analysis on Basel IV with our clients. And yeah, we are sorry that it took us so long to post the next video, but it's definitely worth that you were waiting so long, because we want to use the experience we were collecting in all these impact analysis and speak about all relevant topics of the Basel IV framework again and in more detail. So we are in the next episodes touching again on all relevant topics, no matter if it's credit risk, market risk or operational risk, no matter if it's standardized approach or internal models, and we want to give you more insights on what are the most critical points, where do you need interpretation, and where do we see the highest impact on the risk-weighted assets. Today we want to start with, I would like to say, the most important approach for the calculation of risk-weighted assets in the future, and that is the new standardized approach for credit risk. And why is it so important? Of course, for the banks that are using the standardized approach, it's definitely important because they have to implement it. But remember, there is the capital floor, and therefore also the banks that are using internal models, especially the IRB approach for credit risk, they must calculate the risk-weighted assets according to the standardized approach in the future in parallel, and that will be the assessment base for the capital floor. So the risk-weighted assets of an IRB bank cannot fall below the 72.5% of the risk-weighted assets of the standardized approaches in total, like including market risk and operational risk. As always, I have two additional experts here with me that would like to explain to you more in detail the standardized approach for credit risk. Today it's Jean-Philippe and Andreas from our Luxembourg firm. So please, JP, Andreas, the stage is yours.
Okay, so thank you very much for having us today. My name is Jean-Philippe Maes. I'm a partner in the Luxembourg firm where I run the risk management practice, and of course, this topic of Basel IV is a very important one in our area. And I'm joined today by Andreas.
Yes, hello, my name is Andreas Drossel. I'm audit director here in PwC Luxemburg, and I'm working as well as regulatory specialist in Jean-Philippe's team.
So, on this Basel IV channel in this edition, the agenda will be to give you a quick overview as to why we are having a new standardized method for credit risk, and what were the motivations. We will see that there are, and one of the leading ideas was to introduce some due diligence requirements. So therefore, we'll see a bit how that's come about. We'll look at how to treat the different types of exposure, so the evolution basically compared to what we've had since Basel II 10 years ago. And then Andreas will also say a word about specialized lending, because there's quite some novelty. We will then cover how to treat equities, subordinated debt and retail exposures, and some extra further changes for that may be more material for some parts of the world than others. Okay, so if we are clear on the agenda, I suggest we start really with the subject matter here, and maybe a first recap of what we are talking about today. In the top box, you see this solvency ratio or capital adequacy ratio, as it's also known, which includes as numerator different quality of capital, of own funds. At the denominator, different types of risks, and mostly credit, market, and operational risk, you can see here. And the ratio of those two parts needs to be at least 8% or more, depending on what bank you are and where you are in the world. Today, we'll be specifically looking at credit risk, so the first little block. And in credit risk, then we can look at the bottom box, there are different compartments, and today we'll be specifically looking at the first one, CRSA, so Credit Risk Standardized Approach, which, as we will see, will apply to absolutely all banks, especially bearing in mind the fact that even the banks with internal models will be subject to flaws based on this standardized approach. So I think that sets clearly the scene for what is to come, and that all banks should really listen and pay attention to this standardized approach. So what were the motivations really for revision? You might say, well, we have a standardized approach, so why do we need to change anything? What was the criticism and the reason for the changes? As you can see on this slide, some weaknesses were often mentioned. Number one was insufficient risk sensitivity, a dependence on external ratings, though that differs on where you are in the world. Some countries had already addressed that one. Some outdated calibration, Basel II, which really is the last time that these standardized approaches were addressed, is more than 10 years old now, probably 14 years actually since the standard was cast. And also the fact that some national discretions allowed for different applications in different parts of the world. So in response to that, the objectives really of this Basel IV is a balance between risk, sensitivity and complexity. Also, in a way, well, not trying to get rid of internal models, but certainly to constrain them and make sure that they cannot be used to unduly optimize capital requirements. And for us, in the EU, it is expected that the transposition of all these rules will apply from January 2022, so just under 4 years from now. The rules and what we will be talking about today are based on the paper published last December, on 7th of December 2017 by the Basel Committee, and you've got the references on the right-hand side. And for information, this was the last part of Basel IV to be published because it was the most contentious one, especially the levels of the flaws that will have to be applied for banks in internal models was very contentious, and that's why it took longer than expected to actually come to a final text. So I was talking about the due diligence and the need for more risk sensitivity, and maybe I'm going to ask Andreas to comment a bit more on how the Basel Committee wants to reduce its dependence on external ratings.
Of course. Thank you very much, Jean-Philippe, for presenting the overview. Consistent with the Basel Committee's guidance, banks must perform a due diligence to ensure that they have adequate understanding of the risk profile and the characteristics of their counterparties. For example, if ratings are used, the due diligence is necessary to assess the risk of the exposure for risk management purposes and whether the risk weight applied is appropriate and prudent as well. The sophistication of the due diligence should be appropriate to the size and the complexity of banks' activities. That means they must take reasonable and adequate steps to assess the operating and financial performance levels and the trends throughout internal credit analysis. Banks must be able to access information about their counterparties on a regular basis to complete the due diligence analysis. For exposures to entities which belong to consolidated groups, the due diligence should be performed at the solo entity level to which there is a credit exposure. In evaluating the repayment capacity of the solo entity, banks are expected to take into account the support of the group and the potential for it to be adversely impacted by problems within the group. Banks should have in place effective internal policies, processes, and systems as well to ensure that the appropriate risk weights are assigned to counterparties. That means they must be able to demonstrate to their supervisors that their due diligence analysis are appropriate. On the next slides, you will better understand how those due diligence requirements are impacting the different exposure classes. We will start with the exposure to banks. A bank exposure is defined as a claim on any financial institution that is licensed to take deposits from the public and is subject to appropriate prudential standards and level of supervision. Those exposures will be risk-weighted based on the following hierarchy. The external credit risk assessment approach is for banks incorporated in jurisdictions that allow the use of external ratings for regulatory purposes. Banks will have to assign to their rated exposure the corresponding base risk weights according to the table shown in the middle left on this slide. Banks incorporated in jurisdictions that allow the use of external ratings must only apply standardized credit risk assessment approach for their unrated exposures. Exposures with an original maturity of 3 months or less can be assigned a risk weight that corresponds to the risk weight for short-term exposures. As already mentioned before, banks must perform due diligence to ensure that the external ratings appropriately and conservatively reflect the creditworthiness of its counterparties. That means if the due diligence analysis reflects higher risk characteristics than that implied by external rating bucket of the exposure, the bank must assign a risk weight at least 1 bucket higher than the base risk weight determined by the external rating. Due diligence analysis must never result in the application of a lower risk weight than the one determined by the external rating. The so-called standardized credit risk assessment approach is for all exposures of banks incorporated in jurisdictions that do not allow the use of external ratings. For unrated exposures, this approach also applies to banks incorporated in jurisdictions that allow the use of external ratings. This approach requires to classify exposures into one of the 3 risk weight buckets and assign the corresponding risk weights shown in the table on the middle right of this slide. Grade A refers to exposures where the counterparty has adequate capacity to meet their financial commitments in a timely manner. A counterparty classified into Grade A must meet or exceed the published minimum regulatory requirements and buffers established by its national supervisor. If such minimum regulatory requirements and buffers are not publicly disclosed, then the counterparty must be assessed as Grade B or lower. If, as part of its due diligence, a bank assesses that a counterparty does not meet the definition of Grade A, exposures to the counterparty must be classified as Grade B or even C. The Grade B refers to exposures where the counterparty is subject to substantial credit risk, such as repayment capacities that are dependent on stable or favorable economic or business conditions. The published minimum regulatory requirements must be met or even exceeded. If such requirements are not publicly disclosed, then the counterparty must be assessed as Grade C. The Grade C refers to higher credit risk exposures where the counterparty has material default risks and limited margins of safety. Here, adverse conditions are very likely to lead to an inability to meet their financial commitments. If the counterparty does not meet the criteria for being classified as Grade B, or where, for example, audited financial statements are required, and the external auditor has issued an adverse audit opinion or has expressed substantial doubt about the counterparty's ability to continue as a going concern in its financial statements or audited reports within the previous 12 months, the bank must classify the exposure into Grade C. To reflect transfer and convertibility risk under the standardized credit risk assessment approach, a risk weight floor will be applied. There are as well dedicated rules for multilateral development banks for which a 0% risk weight will be applied, providing that certain criteria are met. If not, dedicated risk weights are allocated depending on the external rating, or if external ratings are not allowed, it will be a risk weight of 50%. Jean-Philippe will now continue with the exposure to corporates.
Yep, thank you, Andreas. So exposure to corporates means basically mostly non-regulated entities, so as opposed to banks that Andreas just covered. However, one common point between banks and corporates is again this notion of due diligence that will be expected on the behalf of banks that become exposed to such entities. And here we must differentiate, and that's why you see the 2 blocks really on this slide, differentiate between the jurisdictions where the use of external ratings will be allowed. That's clearly the case for the European Union. But then we need to oppose that to the right-hand side of the slide, where we're looking at jurisdictions that will not allow the use of external ratings, like there are some in the world already today. If I focus on the left-hand side, for those that are familiar with the current standardized approach, you might think, well, there's hardly any difference. Well, actually, there are, I would think, two main differences compared to the rules that are enforced today. And you can see the notion of the base risk weight in the little table on the left. That goes from 20% all the way to 150%, depending on the rating of the counterparty. The one novelty there is for the BBB rated counterparties, corporates, where we now have a 75% risk weight that did not exist before. So this is one of the novelties. Unrated counterparties remain risk weighted at 100%, so no real change there. What is important is a little number 2 there that says that, again, those are minimum risk weights, but the bank needs to do its due diligence to decide whether there's not a need for a higher risk weight, bearing in mind that a lower one will not be allowed. The second novelty is the exemption, so the bullet at the end of the left-hand side, where an unrated corporate small or medium enterprise, so SME, which is defined as having a total turnover of less than 50 million euros, would receive an 85% risk weight, which is also a novelty. Retail SME exposures will, like today, remain at 75%. In case you are in a jurisdiction where those external ratings are not recognized and allowed, then again, by default, risk weight would be 100%, unless you can be in one of the two exemptions that are highlighted on this slide. So either a risk weight of 65% if we are looking at investment grade exposures, and you can see some criteria that need to be fulfilled. And the last one, for example, is that securities of that corporate need to be listed on a recognized exchange. So we're certainly looking at the bigger animals in this world. Or the other way to go below 100% would be, again, corporate, small and medium enterprises with the same 50 million total turnover that would receive also an 85% risk weight and 75% still for the retail SME exposures. So those are, in a nutshell, the main changes with regards to corporates. The next slide is probably going to be quite striking, because if you look at it, what is in bright red on the left-hand side is those new risk weights that I just described on the previous slide. In the middle, you have those risk weights that could apply to in jurisdictions where the external ratings are not used. So you see the different levels, but then you look at the more pink-colored blocks at the right-hand side of this slide, and that's simply where the average risk weight lies at the moment, and is based on a European Banking Authority's transparency exercise. So they looked at what is the typical risk weight we see for different varieties of corporates at the moment. And you can see that we range from the low to mid-40s, whereas it is quite clear on the left-hand side that the new method could lead to significantly higher risk weights than that. So this is why clearly this standardized approach revision could have a significant strategic impact on banks. Now, I'm going to hand over back to Andreas to cover specialized lending, which is where there are also some significant novelties.
Many thanks, Jean-Philippe. I will now continue with specialized lending, which is a completely new exposure class. The main characteristics for specialized lendings are that the exposure is not related to real estate and is within the definitions of object finance, project finance, or commodities finance. Moreover, the exposure is typically to an entity that was created specifically to finance or operate physical assets, and the borrowing entity has few or no other material assets or activities, and therefore little or no independent capacity to repay the obligation apart from the income that it receives from the assets being financed. The primary source of repayment of the obligation is the income generated by the assets rather than the independent capacity of the borrowing entity. Furthermore, the terms of the obligation give the lender a substantial degree of control over the assets and income that it generates. There are three subcategories of specialized lending. Project finance refers to the method of funding in which the lender looks primarily to the revenues generated by a single project, both as the source of repayment and as the security for the loan. This type of financing is usually for large, complex, and expensive installation, such as power plants or transportation infrastructure. Project finance may take the form of financing the construction of a new capital installation or refinancing of an existing installation with or without improvements. Object finance refers to the methods of funding the acquisition of equipment, for example ships or rail cars, where the repayment of the loan is dependent on the cash flows generated by the specific assets it relates to. Commodity finance refers to short-term lending to finance reserves, inventories, or receivables of exchange-traded commodities, for example crude oil or metals, where the loan will be repaid from the proceeds of the sale of the commodity and the borrower has no independent capacity to repay the loan. On the next slide, you can see the corresponding risk weights. Banks incorporated in jurisdictions that allow the use of external ratings will assign the risk weights determined by the issue-specific external rating, if these are available. Issuer ratings must not be used. You can see them on the left side of this slide. There are specific risk weights, you can see them on the right side of the slide, for specialized lending exposures for which an issue-specific external rating is not available, and for all specialized lending exposures of banks incorporated in jurisdictions that do not allow the use of external ratings. It is 100% for object and commodities finance exposures, 130% for project finance exposures during the pre-operational phase, and 100% during the operational phase. Project finance exposures in the operational phase, which are deemed to be high quality, will be risk-weighted at 80%. The operational phase is defined as the phase in which the entity that was specifically created to finance the project has both a positive net cash flow that is sufficient to cover any remaining contractual obligation and declining long-term debt. A high-quality project finance exposure refers to an exposure to a project finance entity that is able to meet its financial commitments in a timely manner and which is robust against adverse changes in the economic cycle and business conditions. There are additional requirements that must be met, such as inter alia but not limited to, the project finance entity is restricted from acting to the detriment of the creditors, it has sufficient reserve funds or other financial arrangements to cover the contingency funding and working capital requirements of the project. Moreover, the revenues are availability-based or subject to a rate of return regulation or take-or-pay contract, and its revenue depends on one main counterparty, and this main counterparty shall be a central government, public sector entity, or a corporate entity with a risk weight of 80% or lower. Let's now move to another exposure class, the equity and subordinated debt, on the next slide. The rules you can see on the left side of this slide apply to subordinated debt, equity, and other regulatory capital instruments issued by either corporate or banks, provided that such instruments are not deducted from regulatory capital or risk-weighted at 250%. Equity exposures are defined on the basis of the economic substance of the instrument. They include both direct and indirect ownership interests in the assets and income of a commercial enterprise or of a financial institution that is not consolidated or deducted. An instrument is considered to be an equity exposure if it is redeemable in the sense that the return of the invested funds can be achieved only by the sale of the investment or sale of the right to the investment or by the liquidation of the issuer. Moreover, it does not embody an obligation on the part of the issuer, and it conveys a residual claim on the assets or income of the issuer. Debt obligations and other securities structured with the intent of conveying the economic substance of equity ownership are considered an equity holding. Conversely, equity instruments that are structured with the intent of conveying the economic substance of debt holdings or securitization exposures would not be considered an equity holding. Banks will assign a risk weight of 400% to speculative unlisted equity exposures and a risk weight of 250% to all other equity holdings. Speculative unlisted equity exposures are defined as equity investments in unlisted companies that are invested for short-term resale purposes or are considered venture capital or similar investments, which are subject to price volatility and are acquired in anticipation of significant future capital gains. National supervisor may allow to assign a risk weight of 100% under certain conditions and within an aggregate limit of 10% of the bank's combined Tier 1 and Tier 2 capital. Banks will assign a risk weight of 150% to subordinated debt and capital instruments other than equities. Any liabilities that meet the definition of other TLAC liabilities and that are not deducted from regulatory capital are considered to be subordinated debt. Jean-Philippe will now continue with the retail exposures.
Yes, absolutely. So it's a very different topic from what Andreas just covered, because Andreas' equity subordinated debt, that was more to do with very large amounts generally, or large entities at least. And now we're looking at retail exposure, which is basically almost the complete opposite. So retail exposure is probably where banks lend to Andreas and I as private individuals mostly, but not only. So for retail exposures, like today, the main risk weight to be applied is going to be 75%. However, some criteria need to be met for that to be applicable, otherwise it is 100%. And the criteria for 75% is basically that it be what I would call plain vanilla products, such as credit lines and revolving ones and personal loans. There would be also, as today in the EU, also the fact that those exposures should be of a low individual value. Today in the EU we have the threshold of €1 million exposure. And the granularity criterion, that one is not always well known, but normally no exposure should represent more than 0.2% of the total loans. So in other words, if all loans to your customers were of equal size, you would need at least 500 of them. That's to give you one idea. What we can see in terms of exemptions, and that is new, is that you could go down to a risk weight of 45% for what they call regulatory retail exposures, and that would include the credit cards and charge cards that have been repaid in full at each scheduled repayment date for the previous 12 months. So that is completely new. That will come as a nice surprise to some business models. It will also be applicable to those facilities where there has been no drawdowns over the previous year. The case of corporate SMEs has already been treated earlier on the slide relative to corporate exposure, so we'll not dwell on that again here. And that takes us then to the next topic, which is residential real estate exposures as opposed to commercial, which Andreas will cover just after this. So residential real estate exposure is key. That's where banks really finance what is called the real economy. So this is probably of interest to many banks. And the treatment there'll be a general treatment, but there could also be an alternative one, as you can see on the left and right hand sides of this slide, respectively. The general treatment is that if some operational requirements are met, and I will come to those in a moment, then you basically look at the loan to value, so how much you lend compared to the value of the security that you get out of the loan. And you can see that this is quite different from what we've got in Basel III today, because in some privileged cases, I would say, if the loan to value is less than 50%, you could go down to a risk weight of 20%, which is totally new and could be good news to some banks. However, the contrary is also true, and loan to value is the other extreme that would be more than 100%, and some of these are still in existence in the world. then the risk weight to be applied would be 70%. So when you think that the current typical risk weight is 35%, this can indeed be a lot more or a lot less depending on how safe, let's say, the investment is perceived. The alternative is basically a simplification of what I just explained, is the so-called credit splitting approach, where you'd have a risk weight of 20% for the first part of the loan, so the one that goes up to 55% of the property value, and the rest of it would be then the risk weight applicable to the direct counterparty, as if it was not a real estate exposure. So what I've just explained applies when the operational requirements have been met. And what are those operational requirements? Well, you can see them on the bottom right of this slide. It has to relate to a finished property, so not something that is being built, and that's a bit comparable to what Andreas was talking about before with the specialized lending. Of course, you need to be able to demonstrate the legal enforceability of and access, and therefore over the property that is used as collateral. You need to assess the ability of your borrower to repay the mortgage. You need to have a permanent valuation of the property, and that is one where I would put really some attention, because valuation can mean different things to different people and in different contexts. So one to bear in mind. And of course, as always, you need to document that right. Otherwise, what is not documented is supposed not to be in existence. Those are the key aspects. But as you can see at on the left-hand side at the bottom, and we have not had time to cover it in more detail today, there are special rules for those acronyms that you see there. First one stands for income-producing real estate, and the second one stands for acquisition, development, and construction. Sorry, where different rules and specific rules apply, and that could also be of particular importance to some business models. Then that was for residential real estate exposures. I'm going to hand over to Andreas now for the commercial real estate ones.
Yeah, thank you, Jean-Philippe. We'll now move to the commercial real estate exposures on slide 14. The commercial real estate exposure is an exposure secured by any immovable property that is not a residential real estate. The risk weight to be assigned to the total exposure amount will be determined based on the exposure's loan-to-value ratio in the table on the right of the slide. The risk weight of the counterparty for an unsecured exposure refers to 75% for exposure to individuals, 85% for exposures to small and medium-sized enterprises, and for exposures to other counterparties. As an alternative approach, some jurisdictions may apply a risk weight of 60% or the risk weight of the counterparty, whichever is lower, to the part of the exposure up to 55% of the property value, and the risk weight of the counterparty to the residual exposure. There are special rules for so-called income-producing real estate when the prospects for servicing the loan materially depend on the cash flows generated by the property securing the loan, rather than on the underlying capacity of the borrower to service the debt from other sources, for which the risk weight goes up to 150%. The primary source of these cash flows would generally be lease or rental payments or the sale of commercial property. The distinguishing characteristic is that both the servicing of the loan and the recovery in the event of default depend materially on the cash flows generated by the property securing the exposure. For land acquisition, development, and construction exposures, there are also special rules applicable. Those exposures refer to loan to companies or special purpose vehicle financing any of the land acquisition for development and construction purposes, or development and construction of any residential or commercial property. Those exposures will be risk weighted at 150%, provided they meet certain additional criteria, as for example, if pre-sale or pre-lease contracts amount to a significant portion of the total contract, or, for example, substantial equity at risk, the risk weight would be 100%. We are now approaching the end of this Basel IV channel, but before doing a wrap-up, we will shortly present you some further changes on the next slide.
Yeah, and those are highlighted here. Actually, for us in the EU at least, the first two ones are fairly limited changes. Well, number one is even no changes per se, because you can see that in the case of defaulted exposures, so those that are more than 90 days past due, and then the situation isn't changed. It's a risk weight of 150% to be applied if the specific provision on that exposure was less than 20% of the outstanding amount, and the risk weight of 100% if the provision was greater than 20% of the outstanding amount. So that is basically saying that you will be penalized by a higher risk weight if you were not prudent by means of specific provision. And there is a very limited change there, at least in the EU. The second part refers to the off-balance sheet exposures, which is basically where there is a potential commitment on the behalf of the bank, and therefore the bank is also exposed to credit risk. And there are two novelties. The first one is at the bottom, where you can see that credit conversion factor, so CCF of 10% is introduced and 0% is no longer in existence. That can be significant impact for some banks again. And also for commitments that do not meet the definition of the other four categories, there's a new credit conversion factor as well of 40% that is introduced. So those are points of attention if your bank is active in those markets.
I will now continue with other assets and the currency mismatch. For other assets, the general standard risk weight for all other assets will be 100%. Nevertheless, a 0% risk weight will apply to cash owned and cash held at a bank or in transit, and gold bullion held at a bank or held in another bank on an allocated basis to the extent the gold bullion assets are backed by the gold bullion liabilities. A 20% risk weight will apply to cash items in the process of collection. For unhedged retail and residential real estate exposures to individuals, where the lending currency differs from the currency of the borrower's source of income, banks will apply a 1.5 times multiplier to the applicable risk weight, subject to a maximum risk weight of 150%. An unhedged exposure refers to an exposure to a borrower that has no natural or financial hedge against the foreign exchange risk resulting from the currency mismatch between the currency of the borrower's income and the currency of the loan. A natural hedge exists where the borrower, in its normal operating procedures, receives foreign currency income that matches the currency of a given loan. A financial hedge generally includes a legal contract with a financial institution. For the purpose of application of the multiplier, only these natural or financial hedges are considered sufficient, where they cover at least 90% of the loan installment, regardless the number of hedges. We did now reach the end of this Basel IV channel and hand over to Martin.neisen for his wrap-up and closing remarks.
Yeah, thank you very much, JP. Thank you very much, Andreas, so far for the presentation. Extremely interesting, and I can see that there are a lot of challenges also in the standardized approach. Looking to all these challenges, what would be your personal advice? What is the first and most important thing that banks should do now to face these challenges?
So thank you, Martin, for your question. Banks, in my opinion, and based on our early experience with banks, what they should do now is really try to go into the nitty-gritty and assess the impact of those new rules on the specific business models. We've seen some clients that have tried to do it at a very high level and have applied some rough risk weights to their activities, and then where they were challenged by us, they realized that we had to all agree that the devil is in the detail, and maybe it would be a bit wrong not to go to that level of detail and have a higher level of confidence in your first estimates.
Basically, I totally agree, Jean-Philippe, especially for the new exposure class, which is specialized lending. The banks need much more information about the project they finance than in the past, because as explained during the presentation, there is a difference between project finance and object finance with the different levels, and the banks need to have sufficient information in order to assess whether it belongs to project finance or object finance, for example.
Yeah, JP, Andreas, thank you very much for this really detailed and very interesting presentation about the new standardized approach for credit risk. As I thought already from the beginning, the devil is like always in the detail, and there will be a lot of challenges for the banks when it comes to the implementation of this new standardized approach. But I think even more important is the business impact and the implications on risk-weighted assets. We have seen there are so many changes, and in some cases we have an increase in the risk-weighted assets, in other cases we have a decrease. I think it's very, very important that banks have to analyze what this impact is, because in the end they will have to consider it also in their cost of capital calculation and also in their pricing. So they're very important decisions that have to be done in the next months. Do not hesitate to contact us as PwC if you need any kind of support in performing these more detailed impact calculations for the standardized approach for credit risk. We have some really good tools developed on this. For those of you who are following this YouTube channel, we have posted already some demo versions of it here, and you can watch it. So whenever there is any questions, you can contact us at any time. So I would like to say thank you again to the speakers. Thanks JP, thanks Andreas, and I also would like to thank you for your attention, for watching this video, and I hope you will also watch the next episodes of our Basel IV YouTube channel. Thank you very much and see you soon.